Hey everybody, it's Ken Perry with Broker Knowledge Group, and it's time for a Wednesday update, and I'm ready to give you an update because I just got back from the Sales Mastery event with Todd Duncan, Dave Savage, and crew, and it was an amazing event, and there were about 800 people there, all loan originators, couple real estate agents, but man, I wish there were more because it was so awesome to get totally excited about the business, to realize that we can be as successful as we want to be, and I'm just coming back totally pumped. So I'm hoping that even if you weren't at that event, you can talk to somebody who was and find out all the great, amazing things that they learned. So anyway, compliance update for this week. A few major issues. Number one, Fannie, Freddie, and FIFA just came out a couple days ago and said that they're going to do a refi for everybody that doesn't count an appraised value. So basically a new AVM type refi. And they're rolling it out. And the reason it would work, it's part of the HARP program, the reason that it would work more than the other programs have is because it gives banks immunity. So if a bank does a loan, there's a lesser buyback on that bank if the loan goes bad. So they're more likely to actually participate, where in the past they haven't participated nearly as much. So anyway, I'm pretty excited about that program only because I think it might just help people who have been making their payments and would love to refi and continue to make their payments. A lot of the programs we've seen have been for people who don't make their payments. It's just cool that somebody's looking out for the people who do. On that note, if you do make your mortgage payments and you make all your rest of your credit card payments and you have very low consumer debt and you have a, let's say, 800 credit score, FICO has announced you're the new problem with America. I don't know if you saw this, but FICO just released this new update. I'll put a link to it on this video. But FICO just released an update that says basically the problem in America that we're not paying attention to is that really good credit score borrower. So those of you with great credit scores, you're the problem. And the reason is this. Once you reach up into the 800 credit score range, if somebody in that credit score range forecloses, it was probably a strategic default. In fact, let me show you the chart. That's the chart that Fair Isaac released over the last couple weeks. And the chart shows you if you have an 800 credit score or so, you're likely to be a risk for strategic default. Now, why do they tell you this? Well, obviously it's going to go into the new modeling system. So if you are a great paying borrower who has low consumer debt, maybe you did Dave Ramsey like we did, you did the program, and you got rid of your debt, you're the problem in America and they're coming after you. So I thought that was just a really interesting update. That, by the way, report was shot over to me from a good friend of mine over at First American Title. So thank you for that. So anyway, just crazy stuff going on in the market. So we've got the Fannie Freddie refi, we've got the new credit scoring thing, but then the bigger thing that I've run into this week is the Bureau came out with their examination manual. So the Bureau of Consumer Financial Protection is the group that regulates every state banking entity, state mortgage, state broker, state banker, whatever you are, they're your new boss. And so they just released their examination guidelines. It's on consumerfinance.gov. And if you read them, you will be amazed. Basically, every single company is going to need to, sometime this year as quickly as possible, sit down and pour through their compliance manual. Because what I'm finding is the Bureau has chosen to really give their examiners a list of things to look for, all within your policy books. And unfortunately, a lot of the companies that I know don't have policy books. Or if they do, they don't cover these things. So if you are a compliance officer or a company owner, please go to consumerfinance.gov, click on the examination manuals, read them, and then compare them to your current policies. It's going to be amazing when you first look at it. You'll go, oh my gosh, this is crazy. So when you first look at it, it's going to be a little shocking, but sit down with them, compare them to your policies, and be ready. Is the Bureau hiring? Absolutely. The Bureau of Consumer Financial Protection is hiring in states so that they won't be coming out from DC to your office, they'll be coming out locally. So they are hiring all over the country to try and get this examination thing running. Remember that the new people who are running for Congress, people who are running for president, they're all talking about repealing Dodd-Frank, or many of them are. And if they want to repeal Dodd-Frank, then the Bureau technically, which is created under Dodd-Frank, is going to need to be able to say, look, you can't repeal us, look what we've done. So they're going to need some things to say, which means they're probably going to launch some examinations fairly soon. One final thing on that, they rolled out a brand new good faith estimate. They did it last week, and it's not nearly as good as the last one. So if you remember Nandina and Jasmine, those were the two last models they rolled out, which were really good. The newest one, also available at consumerfinance.gov, is the one that they're testing now in many regions. It basically looks like the old good faith. Couple things to point out on it though. Number one, it's great because the APR section says this is not your interest rate, which will help borrowers understand that APR does not equate to interest rate. The second thing is they have payments and they have cash to close. Those are really good. The problem with it though is there are a couple new calculations that I'm trying to figure out. So those two calculations, one of them calculates the amount the mortgage company pays for the money to lend to the borrower, which is a little confusing. The other one is called the TIP, which is a total interest percentage, the percentage of the total loan amount that is being paid out in interest. So if you take a $100,000 loan and let's say $80,000 of the payout over 30 years is interest, it's an 80% TIP. So a little bit interesting. So we're waiting on a final copy of that good faith. I thought we were getting closer than Indiana and Jasmine release, but this new one, I don't know where, it came out of left field and we have really no guidance and it went from 2 pages to 3 pages. So if we keep this consistency that they've got now, you know, who knows if we get back 4 or 5, 6 pages of information, which then of course we know the borrower's not gonna read. That is 6 minutes. You guys have a great week. I will see you later. If you're not following them already, follow the Hughes Troop. Go to Hughes Troop on Facebook or type in Hughes Troop to Google and you will get the Hughes Troop. Support Dustin Hughes in his battle and read him because he's making some, he's blogging and just really bringing some motivation to the industry. You guys have a great day. I'll see you next week.